Welcome back to the Perpetual Wealth Podcast, a show for clients of Paradigm Life. This season, we're empowering you to take control of your financial future using the core principles of the Perpetual Wealth Strategy. Now, before we dive in, a quick but essential disclaimer. While this podcast is primarily for our valued clients at Paradigm Life, it's open to anyone interested in enhancing their financial knowledge. However, please remember that our information should not be taken as a direct tax, legal, or financial advice. We strongly recommend consulting with a wealth strategist at Paradigm Life or your financial team before making any decisions based on our discussions. Today, we continue our journey into cash flow, protection, and wealth building, the foundational principles of the Perpetual Wealth Strategy. Let's dive in and explore how to optimize your wealth and achieve financial independence. Your journey continues now. In the next video, we're going to cover a core foundational product to the Perpetual Wealth Strategy called the Wealth Maximization Account. Now, a holistic strategy, again, with regards to cash flow optimization, ideal, adequate protection, as well as the different investments and financial products that make up your wealth strategy. Okay, we have to pay attention to all of these and how they work harmoniously together. And so, what we're going to talk about today is why the Wealth Maximization Account is our core financial product. I would say right out of the gate, it's a financial product that does more than one thing. Typically, an investment or a qualified plan, it has one intended purpose. And looking at this, really incredible financial vehicle, it plays multiple roles, and also multiple roles in different phases you have in life. Whether you're just starting out, whether you're at the peak of your career, or whether you're unwinding and getting ready to retire, and then even passing on a legacy. This is a financial product that plays not just many roles up front, but multiple roles along the way. So we're going to get into the nuts and bolts of how it works. So the first thing we got to say is, like, this is a life insurance product. Okay, the Wealth Maximization Account is a high cash value life insurance policy, usually underwritten and provided by a mutual insurance company. Now, looking at the design, that's what's most important. So life insurance has evolved over the years, right? A long time ago when it was first, I would say, introduced before the United States even existed, but as it was brought to the United States from Europe, it was more of like a communal type of insurance where communities would get together, typically churches, and they would all contribute, right? We call them premiums now, but they all contribute to a big pool of money. And then ultimately, if the loved one of an individual passed on, this money would pay out to them. And this kept going until they became formalized institutions. And then as those institutions evolved, they became stock-based companies, and then mutual companies, and then the types of policies that have been created since then. You have term life, you have universal life, you have whole life. There's all sorts of different life insurance products that are out there. So our goal is to help you understand really the role of whole life as it pertains to a comprehensive, holistic financial strategy, and why. And looking at really the Wealth Maximization Account, whole life, we have come to realize is just a financial product you can count on. It's something that has stood the test of time. It has performed, and just based on the structure and how it works, it's what we feel most confident in. Now, high cash value, I would say, is a change to how life insurance typically worked, where you pay a premium and you get a benefit if somebody passes on. But life insurance cash value became this idea where now you have a kind of a savings component of a policy that you can access as a living benefit, as opposed to benefits being accessed once you pass on. So we're going to get into cash value and how that works. But the IRS got involved because life insurance essentially was to replace income, and so there was no taxes associated with the growth of cash value or with passing a death benefit on to a beneficiary in an estate. But the IRS got involved and they started to regulate the tax benefits that still exist. But the high cash value idea is ensuring that you abide by, adhere to some of the rules of the Internal Revenue Code, and we're going to get into that as well. But the wealth maximization account, it distinguishes itself from other financial products just because of the different roles and different characteristics that it plays. It's kind of like sometimes I refer to it as a Swiss Army knife, right? It's like one tool, okay, but there's multiple micro tools associated with it, depending on the circumstance that you're in. So, John, before we get into how this type of insurance policy works and why it's foundational to the perpetual wealth strategy, maybe add to what you have learned about life insurance over the years and why in your perspective we advocate it so highly.
Wow. um, yeah, it's, I look at, you talk about the change in life insurance. You talked about term and whole life, which were kind of the core, and then you have your UL products. And I like to look at, term was kind of like renting a place, that served a purpose, right? Not the most effective for growing any kind of wealth, but it put a roof over your head. Obviously, you're renting, there's no tax implications or benefits, etc. Where whole life is like buying a property. All of a sudden, you've got a lot more things. You talk about that Swiss Army knife. You build cash value. You have asset protection. You have tax benefits. So very similar to buying a property. All of a sudden, you change the dynamic. You still have a roof over your head. You have a lot of additional benefits behind it. And I was a huge buy term, invest the difference. As a young father having two young kids, I think it was 4 and 2 when we had a really close friend pass away, and seeing the effects on that family was quite eye opening. And then having my sister and her husband passed away and left her with 5 kids under 10 years old, and just the effects and choices and everything had a profound effect at me very young. So I always wanted insurance, just seeing and making sure I honored that commitment to my kids and my wife that I felt like I should have. That's why I started with term insurance. And as I've started to learn more and build, you look at that, learning the importance of cash flow, learning the importance of protection as I built my wealth up, had a massive change in the effect and the product and tool I used to do it.
It's interesting that you look at the evolution of life insurance. I think intuitively, the reason why it has existed so long is because it makes sense, right? The inevitability of life that we can't circumvent is death, right? We haven't figured that out yet. Now, there's probably people that are trying to work on that, and obviously, there's lots of medical innovation and evolution as well. But still, that's an inevitability that we're all going to face. So that's why I think the product has existed for as long as it has. But human nature has taken hold, and human nature is to make it even better, right?
Yeah.
It's kind of like how we've evolved technologically, medically. Like we're always trying to find like, okay, how can we improve this? How can we improve that? So I look at in the beginning just being covering the loss of a loved one, but then to becoming institutional, and then with a mutual company, they involve policy owners as part of their profit sharing, right? And so they distribute dividends to specific policy owners that own specific products. But then, you look at the early 1900s, and this was really the primary predominant savings vehicle. The 401ks didn't exist, mutual funds didn't exist. The stock market was reserved to just like a few,
Companies,
a
yeah.
few percentage of the population. And so life insurance was that primary vehicle. And so farmers are the ones that really advocated for policy loans, because with farmers they don't get a paycheck every single month or every other week. Okay, they have essentially their harvest season where they get all of their money, but they have the planting season. There's a big gap in between, and sometimes the harvest doesn't happen the way that they had anticipated. So they are the ones that advocated for, okay, how can we take as opposed to withdrawing money or canceling our life insurance, how can we establish some sort of loan so that we can borrow against that cash value, so that when we're planting, we can live, and then when the harvest happens, we can pay back the loan with interest, right? So it's interesting how that's evolved. And then since then, policy design has changed. There's different riders. It's really interesting. So how we look at it, because it can be really confusing because there's so many nuances, so many riders, so many so much flexibility that it has now. It's how do you help essentially clients use this tool as a foundational product. So one of the main reasons why we covered context in the beginning, right, is so that we can show you based on the different characteristics whole life has, okay, how it applies to cash flow, how it applies to protection, and how it applies to wealth.
Yeah, and just to back up a little bit, you talk about it. It obviously makes sense. It's been around forever. You bring up farmers using the policy loans. Farmers are usually are the ones that originally came up with the concept of sharing risk
Mm-hmm.
for the same thing. Not only to the space of time which they wanted the policy loans, but really, if one has a drought, one has flooding, one has bugs or whatever, they pooled the risk. So they would, instead of putting together money as premiums, they'd put together seed as the premiums and share in that overall risk. And you look at making sense. One question we get a lot is, oh, it's tax free. There's tax benefits. Is that a loophole? Is that going to go away? It makes sense to the government too, because if we will go in and assume the risk as a primary income earner and make sure our loved ones are taken care of, that takes a burden off the federal government. So if
Because they don't have to be the social safety net
yeah,
in the event that families are left without a breadwinner.
yeah, you look at if the breadwinner passes away, it's a very high 80-something% chance that they will go on some sort of government assistance. So as an overall strategy, as not only individually, but as a community, as a country, it makes a lot of sense to have this as the foundation.
So State Farm, that's where State Farm came from, or farmers, that's where farmers came from. Yeah, no, it's interesting. It's interesting to look at the evolution, right, of our economy as the United States economy, and this was definitely a key financial product. And we're not going to get into the history and what's happened since then, but still some of the strongest institutions in the country are insurance companies because they are obviously regulated to a certain
The
standard,
longest
much higher standard than
financial
banks or other
institutions,
financial
yeah.
institutions, but they also bear this type of risk pooling, right? Which back in the farmers era, obviously math existed, calculus existed, actuarial science and equation has existed, but I would say life was different back then. There were way more risks, whether it was health risks or whether it was casualty type of risks. Risks have gone down, and obviously actuarial science has drastically improved, being able to assess risk and be profitable with that risk. That's what's also cool about these mutual company structures is they improve the way in which they're able to pool risk and price it and ultimately pass on those benefits to policy owners in the form of a dividend. And we'll get to that a little bit later in our series. But let's just get into essentially the characteristics of just whole life, what whole life is, what are some of the characteristics that it has? Because obviously the wealth maximization account, as we've mentioned, is high cash value, whole life insurance, but we're just going to get into whole life insurance and how it works.
I think insurance in general is very misunderstood. And obviously, Wall Street, the banks, they want our money, so they're going to discourage us from getting any type of insurance, right? So the normal talking heads are very anti-insurance. So because of that, I think people don't understand their options. And I like to look at, kind of use my experience in business and real estate for me to make sense of what we have. And so I'm going to use that. If you look at term, it's a period of term. It's like renting an apartment. We sign a 1-year lease, a 6-month lease. A term is 5, 10, 20, 30 years. For a period of time, we're able to hedge that risk. You look at whole life, again, very similar to buying a property. So if we go buy a $500,000 home and do a 30-year mortgage with a 5% interest rate, very easy for them to pick our payment of what's going to be made on that home. Well, a whole life policy is very similar. They use the actuarial science to determine what our average life expectancy is, and they look at our current age, and now they can determine if we buy a $500,000 life insurance policy, we're essentially financing a predetermined benefit at the end with a very unique clause that if we pass away before it's paid for, they're still going to give us the asset. Very unique.
So that's the contract. So I would say the
That's
first
contract
bare bones is you sign a contract with an insurance company for those reasons, right?
Yep.
They obviously have different actuarial tables. They price in what it will take to get this $500,000 at mortality, which right now mortality tables are at 121 years old, right? But anytime in between. So perfect analogy. But that contract is a legal binding agreement. As long as you pay your premiums, insurance companies are required to pay out that. Now, there's other pieces of that contract. That's the primary piece of the
Yeah.
contract.
Yeah, and that's that's essentially how we pool our risk. Is we know on average, we're going to live into our 80s, but we could be the statistic that passes in our 40s or our 50s. So for a very small amount of money, we're able to shift that risk to an insurance company, which is essentially, if you go with a mutual insurance company, it is a pool of all of us, and we share the risk individually in case we are that statistic doesn't make the average.
Now, we're going to get into what cash value is in a second, but we're mainly focused on just that primary benefit. One way
Yeah.
I really understood it in the beginning was I'm paying a premium for my legacy. Like this was a financial benefit that will go to my estate. It's the ideal vehicle because once the demise happens, it pays out immediately. And it pays out in a very tax efficient way, whether it's for covering end of life expenses, whether it's covering and replacing income of those that you were supporting with your income, or it could fund a legacy. And funding a legacy isn't just like sending a dollar amount to somebody, but you can essentially uh, use entities and use legal directives so that that money is passed on according to predetermined directives.
Yeah.
All right, so we get into that, and that's where I think we all feel we have a limited time on Earth, right? So we all want to make a difference. I think that's intuitive to all human beings, right? We want to place our mark on the world, and leaving a legacy, leaving the world better than we found it, is, I would say, intuitively important to us. So leaving behind a burden, whether it's end of life expenses because of long term care costs, right? Or leaving behind unresolved matters with a business. And there's so many different experiences we've seen, right, that life insurance helps covers in that event, especially a premature event.
Absolutely. And it can, everybody has a different viewpoint. It's really, meeting with thousands of people. Some are very big on providing a legacy. Some people don't even know how they're going to make it to the end of their life without being a burden. So planning a legacy is something that's very hard for them to even comprehend. And some don't want to leave a legacy based on what they've seen. This is kind of some of their anti-insurance views is, I don't want to ruin my family with all this money. And all that comes down to just knowing, going back to the perpetual wealth strategy. It's a strategy through the growth, the income, the legacy
Mhm.
phase, and not just a single event or a single product. And I think that's so important as we look at building these out and deciding how we're going to place our money.
Cool. So another characteristic of just outside of this permanent death benefit, and it's a permanent death benefit that pays out regardless of when that event happens, is the idea of cash value. Now, cash value was another evolution, right, in the history of insurance, where people had policies, they were paying into it, and that if they did not have the means to continue that for the rest of their life, okay, they would lose it. So they'd pay all this money in and get nothing for it. So that's when it evolved into essentially having a cash, a liquid, or a refund value, which is, here is a schedule associated with that contract that we were talking about. In that same contract, it gives a schedule of that cash value, and ultimately what that will be at what age, so that in the event that you no longer wanted the policy, this is the liquid value you would get back.
Yeah, and if we, again, kind of taking it back to like a property contract of buying a house, the cash value in a policy is similar to the equity we build in the house. Now, we build equity in a house both through our payments and the principal payments as it goes down and any appreciation in the property. Well, in a life insurance policy, we get the cash value based on our premiums. Just like a mortgage, the first cash value is all our premiums going in, right? But then we start earning a guaranteed return on it, which is like the instead of paying interest to a bank, we're earning interest on our cash
Mhm.
value. And then the dividends are kind of like the appreciation in the property, right? We're not guaranteed a property is going to go up, but over time they always do,
Yeah.
right? Same with the dividend in a policy. The dividend is based on the profitability of a mutual insurance company coming back to us as policyholders. So they're very similar products and asset classes. When a lot of people understand a mortgage and buying a property, where the cash value can be a little bit different, but it's a very similar product on really what it's for and what it does.
And that's a cool, I'll expand on the dividend because the dividend is interesting because it is based on the profitability of the insurance company. And that's based on the interest that they earn in their investments, their general account, and then their mortality experience, which is did the number of people you projected to pass on really pass on. And so they distribute that dividend to specific policy owners, right, within what are called participating life insurance policies. Whole life is one of them. And then you look at how the IRS treats that payout of a dividend. Now, most dividends for profitable companies, okay, are treated with taxes. Like you have to pay tax on that gain. But within a life insurance policy with a mutual company, they treat it as a refund of premium. Because if they're profitable, it means that they overcharged you, right? So it's an interesting dynamic. And it's a question we often get from clients, which is this profitability or is this a return of premium? And in theory, it's both, right? The IRS treats it as a return of premium, but it really comes from the profitability of the insurance company.
Yeah, it's interesting because our premiums make us a owner, a shareholder of a mutual insurance company and give us that contract. But then because we are a mutual owner and shareholder of the mutual company, then we get a portion of that profit comes back as the premium refund. So very, very unique contract and how it's taxed.
So a couple other things with cash value. So cash value, and this is ultimately legal and government as well. But when somebody holds money, there's legal requirement to essentially pay out an opportunity cost interest rate, right? So the life insurance policies, the cash value there is accumulating, contractually guaranteed over the course of time, also have interest associated with it. So you don't just get cash value, but also interest associated with that cash value. And then the dividend is essentially paid out on top of that. So the dividend increases the cash value even more. Now we're just basically talking about plain vanilla whole life. We're going to get to the high cash value in the next video, but this is just a plain whole life insurance contract with a mutual company.
Yeah, and it's kind of interesting because if we go back to the contract that we have, it's in essence, the insurance company averages out how long we're going to live, comes up with that premium. But if we pass away in the meantime, they're the ones that assume the risk. So a lot of people go, oh, I want my money to grow more than the insurance company does. Very unique contract in where the other party assumes all the risk. If they don't grow our money, they're the ones that pays out the difference. So contractually,
it's an interesting,
yeah. So it's the only contract I know of where I'm going to place my money where the other party has more risk than I do.
So hopefully you're seeing by now why we consider, because whole life is whole life, we consider this a foundational core financial product because of all the different characteristics that it has, right? It has obviously permanent protection with the death benefit, which can either pay out and replace the income of the breadwinner for if it happens prematurely, or it pays out and funds the estate, whether it's creating a legacy, whether it's paying off debt, whether it's resolving end-of-life expenses, but it also has a savings component. You have liquid value that's building inside of the policy. Then you have a policy loan, which is essentially part of the contract where the insurance company guarantees that you can borrow against your cash value from them. And obviously there's some terms associated with the payback of those loans, which we're going to get to in this series. But the idea is you have a guaranteed loan with the insurance company against this cash value. Additionally, I would say another evolution in whole life is it has ideal asset protection. So the reason why it has asset protection, both with the cash value and the death benefit, is because the policy is not for the individual policy owner. Okay. Now they get living benefits, but technically it is for the benefit of somebody else who does not have that liability. That is why there is great asset protection, both in cash value and in the death benefit. And then obviously there's some more advanced ways in which you can have, trusts and other entities own insurance, but we're not going to get to that. But it's one of those things where, again, another ideal thing that people need when really they have liability associated with their life, whether it's caused by them or not caused by them. Okay, having asset protection shields your assets from creditors who could get a claim on it based on getting a judgment on you if you are truly liable for whatever the event was.
Yeah, great point. A policy, does not replace a trust, but it's very similar to a trust. So, there's the insured, the owner, and the beneficiary. And one difference, I know in some of our series later we'll talk about trust, but this is like a first step in that asset protection, but for some of the same reasons as how a trust works.
So the application, we're going to get into lots of different strategies in this series, but life insurance is used for so many different reasons. Obviously, the indemnifying or replacing income from a business owner, indemnifying that risk is first and foremost. But the use is in business, right? It can be used as part of a buy-sell agreement to buy out an owner in the event of death. It can also be a business succession tool. It can be used to fund educational expenses. Obviously, one of the I would say terms that we use is banking, which using the loan provision, you could essentially use that very flexible loan provision against cash value as opposed to going and getting bank financing. That's an ideal opportunity. It can be used to start a business. It obviously you have the asset protection piece of things. It could be the tool that funds your legacy. What else would you add to that? We've put a big list on it from a cash flow protection and wealth standpoint. Anything you want to add that I missed?
No, I think that's one thing that can make it a little bit more complicated is it's so flexible. So we're used to so many products being very limited on what we can do or how it's taxed, and we have to look at all that. And the policy loan is such an incredible vehicle, but a lot of people have a kind of a negative connotation to loan. But it's the same thing. Like if I have a rental property and I sell it to access my equity or value there, I'm going to pay a tax. But if I loan against it, if I get like a home equity line of credit, I can use all that value, right? And that's very similar. We're using the policy as the asset or the collateral, and we can borrow against it, pay it back. So very very unique contract, and the ability to loan against it is what allows us to maintain asset protection and all the tax free benefits. So
Okay, so
great
that's
summary.
vanilla whole life, base whole life. It's an incredible financial vehicle. It's something we see relevant whether you're single, married, young, old. There is relevance as it improves your financial life. It again helps you to achieve those wealth outcomes that you're striving for with the highest degree of certainty. It's not the only financial vehicle though. But before we get into that, we are going to spend another video talking about what high cash value is, which is the strategic design of whole life to maximize the living benefits. So stick with us to the next video.